welcome. I'm so pleased to be here with Boaz Weinstein. Some of you may know who he is. He is the head of Saba Capital Management. He rose to prominence both as a derivatives trader at Deutsche Bank and then, of course, in 2012, being on the opposite side of the JP Morgan London Chief Investment Officer office, which is known as the London Whale, and has since won this year's Institutional Investor Top Credit, as well as activist hedge fund managers. He is here, and I've got to say, he is here the day after his 50th birthday. Boaz, I want to start with, it's been 35 years. When you were 15 years old, you fell in love with Wall Street. What's changed since then?
You know, turning 50 does feel different, in case anyone's wondering who hasn't done it yet, than 49. And so I have been reflecting a bit. I thought about how I started on Wall Street. I was very lucky to get a job my sophomore year of college at Merrill Lynch after school, full-time in the summer. And I basically spent those years with thinking about Wall Street, being on Wall Street, and playing chess. And I woke up yesterday, a little bit earlier than the rest of my family, and I played 5 games of speed chess and thought about Wall Street. And I realized, like, for me at least, 35 years later, basically nothing's changed. I'm still very passionate about Wall Street. I'm still passionate about chess, and that's who I am.
Well, how do you play chess at a moment like this, or how do you use some of the lessons at a time of such incredible uncertainty when everyone's trying to figure out what the parameters are to even trade within?
Yeah, so, you know, chess is attributed to thinking some number of moves ahead and seeing the future, and I think it's great for a lot of things. It's great for concentration, it's great for planning, but I feel like this market, you know, we have this heavy fog outside thanks to our Canadian friends, and we have, I think, a big fog. We have a big fog in the market because, you know, the bond market was pretty sure that the Fed was done like a hike ago, and now and this one was a mistake. But all of a sudden now there's maybe going to be another one or two to come, or 50 in July, and so the market is constantly wrong, and individuals are wrong. Team transitory was said with confidence and then wrong, and I think we just have to accept that there is a thick fog right now, and fixed point prediction. This will happen, that will happen, there won't be a recession, there'll be a hard landing. Those, you know, thinking about chess to figure out 4 moves ahead isn't really the right game. I think it's much more apt to think about poker, where you have an opponent and you raise, you bet, they raise, you re-raise, they go all in, and now you have to think, what do I know? What's the range of hands that they could have? Could they be bluffing? Might they have anything other than pocket aces, for any of you who know what I'm talking about? Or might they have any 2 cards? And so I think right now we're in a almost any 2 cards kind of scenario. There's a lot of chances of different outcomes. And instead of saying, I think there'll be a recession or I won't, or there won't, which I kind of howl at the TV screen when I hear that, I feel like you have to think about ranges of outcomes. And even if, you know, I listened to Stan this morning, his comments were amazing. Like, you go with 40% chance of recession, or Goldman just shifted to 25. The point is that you could have a 40% chance of something happening and still want to make the investment that it happens because it's priced at 5%. And the way I look at credit right now is that there's almost no chance of a real pickup in defaults priced into credit spreads. And so through that range of outcomes informs our investment view, which is that the market, whether you look at the VIX or credit spreads, is not ready for that uncertainty.
Okay, just a full disclosure, Boaz was banned, I believe, from a Scottish poker house for counting cards. Was that correct?
So different game. So we talked about chess.
Oh, that was blackjack,
There's
right?
poker. I happen, in my misspent youth, learned to count cards very well. And a Greek casino on Baker Street in London gave me a letter that Lisa saw when I was late to our meeting that said that I'm no longer allowed to enter on, I think it's 10 Baker Street, or maybe that's Sherlock Holmes. But either way, I'm not allowed to enter, and that's a different game. That's a game where you have every piece of information. There's no uncertainty. What are the odds? And so forth.
So let's dovetail that into how to get an upper hand at a time when you do have this arbitrage, this fog, and you're trying to come up with what the right parameters are. How do you know what's mispriced? How do you know where the probabilities are? What sort of do you look at to make some convictions?
Yeah, so I've always gravitated to arbitrage strategies, not about predicting what will happen, but just security A against security B is mispriced. And actually, by you accidentally mentioning blackjack, just reminded me that Ed Thorpe from Beat the Dealer or Beat Wall Street, this famous MIT professor. If you're watching, it's a bucket list item for me to meet you. And he's still going strong. So he, in the 1980s, did a kind of arbitrage called closed-end fund arbitrage. And I know that Warren Buffett, when in 1950, before he took Benjamin Graham's class, he sent me in 2018 his position report that the majority of Warren Buffett's holdings when he was about to enter that class were discounted closed-end funds. So I'm interested in arbitrage, and closed-end fund arbitrage is the thing I'm most interested in today because it is tangible. It's an arbitrage that you can actually collapse yourself. You don't have to hope that Elon Musk buys Twitter. In merger arbitrage, in cap structure arb, you have to hope the company behaves a certain way or certain outcomes happen. In closed-end fund arbitrage, you can actually control your destiny. So maybe I can tell you why I'm very excited about that now.
Yeah, so closed-end funds, let's just explain. You basically IPO a fund, for anyone who doesn't know, and you sell shares, and then you take the money and you can invest in whatever you want, and the shares should trade at the same price as the IPO or even higher, unless there's some kind of dissonance that you don't feel like you're going to get all your money back. So why are you seeing an opportunity right now in this sphere?
Right. So closed-end funds, open-ended funds, we typically know more about open-ended funds, so mutual funds or ETFs. If you want your money back, you're going to get NAV. It is a arbitrage on an ETF, and in a mutual fund, they'll sell you a little bit of the portfolio, they'll sell a little bit of the portfolio, they'll give you back NAV. You're tethered to NAV, you always get NAV. In a closed-end fund, and there's 770 of them on the New York Stock Exchange and the London Stock Exchange, you have to sell it to someone else, and that might be at a 30% discount to NAV, a 2% premium, and everything in between and more. And so closed-end funds can sit at huge discounts for a very long time. As we talk here today, about 3/4 of the market, the closed-end fund market, which is about a $500 billion market, is trading just fine. Small discount, no discount, premium, but a quarter of it are trading at gaping discounts. And so I look at it like I'm buying dollars for 80 cents. I'm buying a dollar for 80 cents, and unlike most investments where you have to think, what's NVIDIA worth, what's the economy going to do, here, we just have to think, can we cause that 80 cents to go back to 100 through our rights to elect a board that cares about those things. The board is, of course, supposed to be operating to the benefit of shareholders, and they have a magic button. They can press a button to turn their closed-end fund into an open-ended fund. They could turn it into a mutual fund, an ETF, they could tender for shares, they could even liquidate, and they can make that discount go away. That discount today across closed-end funds, $60 billion.
Okay, you're bearing the lead. You've declared war on BlackRock. What are you trying to do here?
So, well, I wouldn't call it war on BlackRock. We've been investing for a decade in this space, and funds that are at structural discounts, that are at double-digit discounts, 15, 20% discounts, even if they hold something as benign as California muni bonds. In the case of, for example, BFZ or MUC, those are two BlackRock California closed-end funds. And in 2020, when we had a mini skirmish with them, on New York muni funds, they just merged them into their New York muni open-ended fund, and every single investor, including the employees at these firms, benefited because they're eating their own cooking, and everyone won. But the reason there's a battle, the reason you called it a war, is because at the upper level of management, which is really the only place where there's any pushback, they would like to keep the money trapped because they'll get a higher multiple from the stock market if it's in closed-end fund form that they can keep forever versus an ETF where the stock market will say, well, people could redeem from that. And so we have 3 live campaigns. One of them is super ironic because it's a campaign on a ESG fund. The ticker for that is ECAT, E-C-A-T. There's a fund called Big Z, which is like Cathie Wood's ARK. It lost, since its IPO in March 2021, it lost 54%. And then a California muni fund, BFZ. If they turned those funds into open-ended funds or conducted tenders at NAV, every single shareholder would win, and that is $580 million to all shareholders from them pressing a button.
How much has your portfolio of closed-end shares increased as a share of your overall holdings?
I, in the past year, have been amazed at how the discounts for some of these funds have ballooned out to 20 cents, 20% discount, and we, in our flagship fund, are 46% invested in closed-end funds. And particularly with BlackRock, because they are the world's largest asset manager, because they are talking the talk on ESG, they're saying, this is how we want to be treated when we are shareholders in IBM or Disney or what have you. I believe they have to walk the walk. They cannot use entrenchment mechanisms to prevent us from putting people on the board. And I'll just say that they're a thought leader, but what they are doing to entrench with respect to stripping shareholder rights, banning shareholder proposals, which they've done, puts them on the G side of governance as the worst company in the S&P 500.
So taking a step back, people might say they came here thinking that you were going to come here and say the world is falling, credit's going to fall out of bed, bet against it, these sort of broad proclamations. And instead, you're finding these sort of nuanced trades that you can arbitrage out right now. So I'm wondering, how do you find more comfort in some of the market technicals and sort of that aspect of the market rather than the fog? How do you sort of dovetail investing in, basically Cathie Wood's fund because you think that it's a correct discount without understanding sort of the broader sphere of things?
Very, very fair. So it is quite easy. In fact, BlackRock's incredible success as a firm, they have lookalike products that are ETFs, and you can hedge that. You can hedge the closed end with the underlying exposures, like Ed Thorpe used to do in the 1980s, or you could, or Warren Buffett thought it was cheap enough that he would hold it just outright. Or you could actually find one of these ETF lookalikes. There's ECAT on the BlackRock side, and then there are multiple multi-billion-dollar ESG funds that are mutual funds that trade at NAV, that are great hedges, that are great merger partners for BlackRock. And so we can eliminate the market exposure and isolate just the discount. And to your question, how do we navigate technicals? Dawn Fitzpatrick was speaking today about how attractive agency mortgages are. And Dan Ivison yesterday about how amazing agency mortgages are, that we have Fannie and Freddie trading at wider spreads for a couple of reasons, one of them being technical, purely technical, than even triple B corporates. So how to navigate technicals, I feel like it's become way more important in this environment. And technicals can sting. That technical can remain. And so one thing that's great about the closed-end strategy is it's a closed loop. You can elect a board that cares to press that button and repatriate in those three funds only $580 million.
Do you also think that the technicals are attractive for agency mortgage-backed securities?
I think they're, for the reasons Dawn mentioned, unattractive. You had 2/3 of the buyers of these products now actual sellers. You have, BlackRock, for example, selling on behalf of Silicon Valley Bank. You have the Fed in almost in QE type of terms, or not QT, not QE. And so you're up against this technical. The technical has created the cheapness, and the technical may very well remain, but it's a very different world. I think it's true for meme stocks as well. We saw it's not about what fundamentally a stock is worth. It's about what are the technicals, when might the technicals change, and that's the biggest driver to me of asset prices in my career.
You talk about technicals, and that really raises a question of the fragility of markets and kind of market structure at a time when you have seen real concentration in a number of funds, and it seems like there is more kind of massive swings in certain areas. Do you feel like this market is more fragile or less fragile than it was a couple of years ago?
I think there's a real fragility which showed itself March 2020 when all of a sudden the bond market and even ETFs were in free fall. And it was really because of this supply-demand imbalance. When I started in the business, it was almost inappropriate to think that a mom-and-pop investor would own junk bonds or CLO tranches. But now, with all of the rise of the asset management industry bringing these products, we just heard today Henry Kravis speak eloquently about bringing private equity to mom-and-pop investors, and that's really double-edged because if it's in a product where they can sell on a day's notice or no day's notice, it can create real challenges. Or if there could be an avalanche because somebody gets their leverage cut in the private credit market and then someone else has to sell. So I think that the fragility remains. It's been it's been tamped down by the incredible accommodation that the government made during COVID, but the danger is still lurking.
Do you think that private credit is an area of substantial risk? Do you think it's in the real estate sector? Do you think that it's just in sort of public credit? Is there an area that you think is most mispriced right now?
I think that private credit gets an incredible amount of airtime, including in today's conference. The speaker before, Mark Lazary, I've heard him on Bloomberg speak about how incredible the opportunity is to make secured loans at 13%. Now that does sound incredible, and you can withstand a pretty high default rate. Now flip it around to the company that's borrowing at 13%, maybe into an economic slowdown, maybe into a world where that 13 will turn into 13.5 because the Fed is not done hiking yet. You have this base rate that has gone from 0 to 5.25, 5, and it's headed higher, if you believe, again, the experts that I have. I don't know what I believe other than to keep a wide range out there. And so private credit, which was a cottage industry a decade ago, $250 billion is now 1.4, 1.5 trillion. And a lot of those companies are going to suffer under the weight of those interest payments. And it is almost for sure, recession or no recession, that the default rate is going to rise. A few weeks ago, 8 companies defaulted over a weekend, including one in your industry, Vice Media.
Carry on.
She looked a little too happy by the way.
I'm not happy about it. I'm just, carry on.
So I think that private credit's full of opportunity, but it's also going to be full of risk, and there will be some potential chaos should it be met with also a slowdown in the economy.
One of your big lures for your fund is as a tail risk fund, and as one that is seeking to preserve capital and then also do well. And I'm wondering, how many investors have come to you recently who are still incredibly bearish and trying to figure out how to preserve their capital and sort of make a profit on it in the way that you're advertising?
Yeah, it used to be you had to find a bearish investor that wanted to invest in tail, and we could not be easily fit into a box. You mentioned we won the Credit Fund Award, but if you look through our portfolio, though it heavily uses credit products, we're really a long volatility fund that will perform well in a bearish market for credit, for equities. And it used to be hard to find investors that really wanted it. But there's been such a change where U.S. endowments, pensions, European investors, they're not looking at it because they're bearish. They're looking at it to say, first of all, is the cost pretty attractive, which it is now, and you think about all the problems in the world and the relatively cheap cost of hedging them. What is your unique brand, if there is one, of how to accomplish that? And then they're thinking about it like, how do I make some money so that when the market, if the market sells off hard, instead of having to sell, I can be front-footed. I can redeem from you, take that money and invest when there's tremendous scarcity for going long, when everyone else is trying to sell, like we saw in March 2020. And so they've been, I think, conditioned already to think about it like a way to protect against, problems that they would face in that sell-off, to instead be aggressive to buy the dip. And tail funds, I think, accomplish that pretty well.
We only have about 90 seconds left, and I'm sure that you spend a lot of time just sitting there thinking, what am I not thinking about? What am I, how do I see around corners at a time when it's your job to do that? So what keeps you up at night now? I mean, what's your biggest concern as you look around at how we're set up?
For the economy or for my own positioning? Well, very different answers.
Both.
Okay, so I think that people have been cautious for a long time. It kind of comes out of the COVID mindset, and you could see a lot of fear in the market. We had Ukraine, we have inflation, we have all sorts of senior loan officers starting to slow down on lending, and you can kind of see these problems. But at the same time, then you see this jobs number, and it's very strong, and you see signs of life. And so I think people are tired of being defensively positioned, and probably have felt some temptation, especially with this AI boom, to say, look, maybe we have to move out of T-bills back into risk. And I think T-bills are so attractive, because wouldn't it be beautiful to stay conservatively invested if you had to be long with that dry powder, if you're not in a tail fund, to sell those T-bills and move in when there has been a real reckoning. I feel like the market is tired of being bearish, and so to have now, looking at just the front month VIX, for example, the fear gauge, to have that now at its lowest point since a month into COVID, or sorry, 6 months into COVID. So almost 3 years now, the lowest point seems kind of wild when you think about all the uncertainty that's in the market. And so I think this is a time to be cautious, because the pricing, leaving aside some AI stuff that can keep going, the pricing is not there, and we should continue to be cautious, even if that's a little bit boring.
Boaz Weinstein, thank you so much for taking the time. Always a pleasure having you.
Thank you, Lisa.